There's one thing that I see on YouTube, Instagram, and TikTok at this point in time that is surrounding the topic of infinite banking or utilizing life insurance as an asset that is driving me absolutely crazy. One thing that I'm hearing said over and over and over again, advice, suggestion that agents, influencers are giving to their clients or using as clickbait, using as content to educate people about how this stuff works. That is simply not true. I'm gonna cover it in this video. Stay tuned. Hey, what's going on, cash flow hackers? It's Chris, Life 180. And today we are talking about the one thing, maybe not the one thing, but the main thing, the number one thing that I am hearing on a regular basis right now that I wish agents would just stop saying. I'm going to dive into it. I'm going to tell you what the thing is, but then I'm going to get into why I think it's so important that agents stop doing this. And if you are somebody who's looking at getting a policy, or if you're an agent yourself, you need to be really, really cautious about the languaging that you use, because it's our job to make sure that our words are looked after, that we are actually being good stewards of our vernacular and how we're serving our clients, because the nuance behind all this stuff is really important. Whole life insurance can be one of the most powerful tools in the world when utilized properly, and you can only utilize it properly if you understand it fully. Education is empowerment. That's what I say all the time. And so this is the one thing that number one thing that people are saying is that you can get a loan, you could take a loan from your policy and you never have to pay it back. I'm saying this, I hear this. I've spent a little time going around internet at this point in time on social media channels, including YouTube, and I've seen so many videos of people making comments about not having to pay it back. I've had literally this week alone 6 conversations with people who have outstanding policy loans. They put tens of thousands, if not in one situation, or over $200,000 into their policy, and then they took loans against it and they haven't paid it back. They haven't serviced it. They haven't managed the interest expense on the debt. They haven't done any of these things. And the challenge is, when I ask them, why did you get the policy in the first place? They were told by people, influencers that you've probably seen on YouTube here, that they didn't have to pay the loan back, that the idea is that you could borrow at 5.5%, but you're earning 6.25% or something of that nature, that there's a positive spread. The policy is always going to grow by more than the interest rate. So I want you to think about this. It doesn't work like that, first of all. Not early in the policy. There is going to get a point in time. I want to get into the nuance on this. There will become a point in time with your policy that you can take a policy loan and you will never have to pay that loan back. That's okay. When we start talking about utilizing the policies as a volatility buffer in retirement, and you're using it as a retirement income supplementation and using it as a buffer strategy for down years in the marketplace, yes, cool, great. You never have to pay that back. Even then, I would argue you don't want to do policy loans. You would want to do withdrawals up to cost basis and then do policy loans once you hit cost basis. That's always the most effective and efficient way to do it. A lot of people say, well, why would you do a withdrawal and not a loan? Because if you do a withdrawal, it's going to lower your death benefit because you got to do a partial surrender. Well, guess what? If you do a loan, it's going to reduce your death benefit because the death benefit is going to be making it up by paying that loan back. So it's going to reduce the net death benefit to the beneficiary no matter what. So there's nuance behind all this, right? There's always a give and a take, and you have to understand what it is. It doesn't mean it's bad. It just means, how are you using this tool as part of your greater strategy to accomplish your financial goals, to get to the life you desire, and to create the life that you want to live, right? That's what this is all about. And what I see, unfortunately, is people that get these policies, they use them for real estate, they use them to buy cars, they use them to buy equipment, and they don't, well, I guess I would say, be a good banker. And, that's one of the things Nelson Nash would say, is you always got to be a good banker. You got to manage the interest on your loans. And I don't know when it got to the point where so many influencers online are coaching people that it's all about positive arbitrage. Remember, the dividend rate is just a gross number, okay? And what I mean by that is that if you have a company with a 6% dividend rate, that's a gross dividend rate. And that's before expenses. It's before what they call mortality experience, meaning every life insurance company is going to have clients that die every single year. They're going to pay a death benefit. When they pay that death benefit, that gets reduced off of the dividend, right? So there is going to be a percentage. And what we find is it's going to be between 10 and 20% of the dividend is going to be what it takes to manage the mortality experience and the admin fees and cost and charges of running the business. And so at the 20% mark, think about it this way, 6%, 20% of that is 1.2%. So you're looking at a net on that of about 4.8. That's what net return in your policy is going to be. But once again, that's only on the cash value, right? That has nothing to do with the fact that you also have insurance charges on the front end of your policy. So during the first 7 years of your policy, especially before you hit that break-even period, it's what we would call the capitalization phase of the policy. How you manage your loans, how you manage your premiums and your flow of capital in the policy is absolutely imperative. It's crucial to the long-term success of the policy in the early stages. Once you get 10, 11, 12 years into the policy, you have a lot more flexibility. I'm not saying don't use the money early in the policy. We have clients that use the money within 30 days on a very regular basis, and that's totally cool. Where it's not cool is when people take those loans and they don't manage the loans properly. That's where people get in trouble. So if that's you, if you're somebody out there that's teaching people to do this, I would say just be really, really cautious and change it up, because you got to educate yourself on a higher level. And if you're a client who's doing this or is looking to do this, or if that's one of the things that is attracting you to the philosophy, I would argue that it doesn't work that way, A, and B, even though it doesn't work that way, it's still a phenomenal strategy, right? And if you want to learn more, if you want to go deeper into this conversation, well then go down in the link in the description below, set up a clarity call. You could talk to one of our aligned wealth coaches and they will walk you through what this looks like. So hopefully that makes sense. Hopefully that adds value into your situation. This is, I'm telling you, it's one of the most misrepresented parts. I know I talk about a lot about the misrepresentations of index universal life insurance. This is one of the most misrepresented components of infinite banking that is becoming more and more widespread. And I just felt compelled to do a video to kind of nip it in the bud. And that's it. So if you have any questions, any comments, whatever, comment in the comment section below. I'll do my best to engage with every single one. And that's it. Make sure you like the video, subscribe if you found value in it. If you know an agent that does this, share this video with them. Maybe it'll illuminate something in their life. So till next time, have a blessed, inspirational day. We'll talk soon. See ya.